Due to questionable corporate political campaign finance practices and foreign corrupt practices in the mid-1970s, the SEC and US Congress, they enacted finance law reforms. In 1977, they came up with the FCPA, or the Foreign Corrupt Practices Act, which criminalized transnational bribery and required companies to implement internal control programs. In 1985, they created a National Commission on Fraudulent Financial Reporting, the Treadway Commission. Now, this commission was jointly sponsored and funded by 5 major accounting associations and institutions headquartered in the US, including number 1, our very own AICPA, number 2, American Accounting Association, number 3, IMA, or the Institute of Management Accountants, number 4, IIA, or the Institute of Internal Auditors, and number 5, the Financial Executives International. This was known as the Committee of Sponsoring Organizations, or the COSO Commission. Now, in 1992, COSO released the Internal Control Integrated Framework, which is now a widely accepted standard that companies use to evaluate their internal control. Now, the content on Internal Control Integrated Framework that we have here in BEC is an overlap with audit. So in audit 3, we looked at 2 parts of the coin, where management was responsible for internal control and the auditors, they came in and they assessed internal controls. In BEC, we are only looking at the business side of the coin, management's responsibility for internal control. So I'll take your leave now and let's have your audit instructor take over from me and explain you management's responsibility for internal control using COSO's Internal Control Integrated Framework. Now, before we start talking about internal controls, I want you to understand that internal controls, what we are looking at from the audit perspective, we are looking at the Internal Control Integrated Framework, which was published by the COSO Commission. Now, COSO stands for the Committee of Sponsoring Organizations. So again, Internal Controls Integrated Framework published by COSO. Now, first thing, what is internal control? So let's say internal control is the process effected by the entity. Its entity's board of directors, their audit committee, their higher management, their middle management, their lower management, so as to ensure that the company has fair and accurate financial accounting and reporting. Internal control also ensures that the company complies with laws and regulations. Internal control helps the company get effective and efficient with its business operations. So these are what we say the objectives of internal control. So once again, the objectives of internal control are fair and accurate financial accounting and reporting, compliance with laws and regulations, effective and efficient business operations. Now, wait a minute. These look like the 3 subjects we have in the CPA exam. The other 3 subjects, FAR, Reg and BEC. Good way to remember the objectives of internal control. We're looking at the Internal Control Integrated Framework. And right there, by COSO. So this integrated framework is by the Committee of Sponsoring Organizations of the Treadway Commission. Now, when we talk about internal control, we know that, right, management is responsible for internal controls. Highlight Internal Control Integrated Framework published by COSO that defines internal controls as highlight a process affected by the entity's board of directors, management and other personnel which is designed to provide underlying reasonable assurance regarding the achievement of certain objectives which relate to number 1, reliable internal and external highlight financial and non-financial reporting. We call this the FAR objective.
Number 2, adherence to applicable highlight laws and regulations. So this one's the compliance or the reg objective. And then number 3, effectiveness and efficiency of highlight business operations. So this one is the operations objective, or as we call it, the BEC objective. So guys, the 3 objectives of internal control are FAR, reg and BEC. Draw an arrow down from reporting and write ICFR. And we're going to talk again and again about internal controls over financial reporting.
So we've just seen how important internal controls are for an organization. We've said that the management is responsible for putting the internal controls in place. Internal control helps the entity meet its financial accounting and reporting objectives, comply with laws and regulations, effectively and efficiently manage business operations. So guys, it's really important for management to have the right kind of internal controls in place. And we may now say that it's a crime for the management not to have proper internal controls. So we would say it's a crime if the management does not have proper internal controls. Guys, the crime, the 5 letters of crime, these are your components of internal control. Let's look at that. So you have the 5 components of internal control, and we say it's a crime for the management not to have proper internal controls. The C of the crime, this stands for control environment. Control environment is basically the tone of control consciousness at the organization. How conscious is the entire organization to internal controls? That's control environment. And we often say it's very important for us to tone at the top, because if the top is toned, if the top is very conscious, it flows through to the entire organization. So it's often said, right, your work, your quality of work often depends on how your boss performs. So let's say your boss works 100 hours a week. You end up working 140 hours a week. So that's about the toning at the top, so that there is proper control consciousness throughout the organization. Now, the control environment, this is the foundation for all the other components of internal control, which we'll look at in a moment. So this is a foundation for all the other components of internal control. So when we say control consciousness, we're talking about the top and the entire organization. Now let's move on. Let's move on our crime. So we've looked at C, control environment. R is risk assessment. Now guys, we've looked at audit risk, fraud risk. That was all risk assessment by the auditor, by us, the auditors. This risk assessment, this is by management. Guys, remember, we're talking about internal controls, and we just said management is responsible for internal controls. So this is the risk assessment by the management to make sure they have proper internal controls. Risk assessment is basically, is the management trying to analyze and think what could go wrong? Are they looking at red flags? So risk assessment, we are looking at, does the management identify their risks, the risks to the organization? Do they analyze their risks? Now, only identifying and analysis does not help. They have to manage those risks. Let me give you a good example here. So let's say there is a change in the operating environment at the company. So earlier, the company used to buy raw materials and sell out finished goods. Now they've changed their operating environment. What they do is they buy in raw materials now, and instead of doing all the production in-house, they have outsourced pockets of their production to various outsourced vendors. So now raw materials come in, they go out to certain vendors, come back as work in progress, and then they go to some other vendors, again come back as work in progress. So earlier, raw materials came in, finished goods went out. Now they've changed their operating environment. They've come with a new outsourcing model where they have outsourced pockets of their production. Now, this would require different internal controls. So earlier, raw materials came in, finished goods went out. Now, we got to make sure when raw materials come in, it's sent out to the vendors, the right quantity, the right quality. We have to make sure the vendors, they're not stealing our raw materials, they're not stealing our work in progress. So now, the internal controls need to be modified, they need to be updated. So this is, guys, a risk to the management. They have to identify the risk. They have to identify that the operating environment at their company, that's changed. They have to analyze it. They have to analyze what has changed. And they have to manage. They have to update internal controls. They need to have strong controls in place when they're giving goods to the vendors and taking back goods from those vendors. So this is risk assessment by the management. Guys, management responsible for internal controls. They need to assess the risks that have happened in their company. Let's say they have new personnel, new accounting team. That's a risk that management needs to identify. That yes, we've got new people. We might just screw up accounting. We might just have wrong numbers here. So this is something that they need to identify, analyze and manage. So maybe if you have new people, you need to supervise them much better than what you used to supervise your older people. So that is risk assessment by management. Let's say new IT systems. So earlier the company, they had pen and paper accountants. So they had a bunch of day books, journal books, ledgers, trial balances, and they had all those big fat registers. Now they have moved to a computerized system where everything is computerized. This is a risk, right? This is a risk because the people at the company, they are still used to pen and paper accounting. They are not so comfortable with the new IT systems. So this risk is something which the management needs to identify. They have to identify, yes, our internal, the way we record our accounts, that's changed. We have new IT systems now. Identify, analyze what's the risk and manage the risk. Maybe they need to get computer experts, IT experts in the company. They need to train the existing employees. So that is very important from the management's perspective to have the right kind of internal controls. Another risk that the management could have is rapid growth. So let's say last year management did 100 million. This year they're doing 500 million. So guys, you cannot operate at 500 million with the same internal controls that you had at 100 million. You have to change your internal controls. You have to increase it. You maybe have to add a lot of internal controls. So this is risk management needs to identify, analyze and manage. Guys, it's basically trying to analyze and think what could go wrong. 100 million, one level. 500 million, update your internal controls. Make sure they don't get obsolete. Let's say new technology. So earlier they had a lot of manual work. Now they're having machinery for everything, automation. So this requires fresh internal controls. New lines of production. So let's say earlier they produced only cameras. Now they're doing cameras and air conditioners. New internal controls need to update, identify, analyze and manage risk to the company. Corporate restructurings, foreign operations, accounting changes, all these are risks that management needs to identify, analyze and manage. They need to be right there. They need to understand its internal controls and they are responsible for their internal controls. Okay, so that was C, control environment. R was risk assessment by management. Now we are looking at the I of our crime, that's information and communication. Now again, this is by management. I don't want you to get confused at all. Internal controls, management's responsibility. So this is all by the management. Information and communication. This is talking about the accounting system. So the question here is, does the accounting system that the client has identify, capture and communicate? So does the accounting system the client has identify, capture and communicate accurate information on a timely basis? So there needs to be proper information and communication within the organization to make sure there are good internal controls. This is one of the components which is required to have the right kind of internal controls. Next we are looking at the M of our crime. This is monitoring. Again, by management. So does the management come back and check the system? So they might have put very good systems in place. They might have a good control environment. They do proper risk assessment. They have a proper system for information and communication. Do they come back and check if everything is going well, if everything is going as intended. How do they do that? Generally, it's the management, they look into the company, they also have an internal audit function. So they have internal auditors who want to make sure that they have strong internal controls. Those strong internal controls create the right financials. There are no material misstatements on the financials that they create. So that is basically monitoring by the management. Guys, remember when we talked about control environment, we said the first P was participation of those charged with governance. So again, when you're looking at monitoring, we can think about that. Does the audit committee come back and see what's happening within the company? Again, if they're busy playing golf, nothing would happen. Internal controls wouldn't be as strong. But if they're actively interested in how the company is operating, how good are they with internal controls, if they look into what the internal auditors are doing, that could make monitoring very effective. So this is internal controls monitoring by management, by those charged with governance. Now we move to the very important E of our components of internal control. This E stands for existing control activities. So the existing control activities at the clients by the management. So you have your day-to-day where you had a lot of mnemonics. So we started with objectives of internal control. Then I told you it's a crime for the management not to have proper internal controls. CRIME. Then I told you as part of the control environment, to have a proper control consciousness throughout the organization, the management needs to place a chopper at the top. Make sure it's properly percolating, everybody's on the same page, they have strong internal controls. Now, so when we had control environment, we looked at chopper. Now when we're looking at existing control activities, we'll look at arcs. Guys, remember Noah's Ark in the Bible? So when we're talking about arcs, we're talking about a ship. So you have a chopper on the top and ship on the bottom. So this is arcs. Now I said arcs, but I wrote arc. The S is silent. I'll tell you why. Let's start with ARC. So these are existing control activities. The A of the ARC, this stands for authorization. So we need to make sure that all the activities that happen in the company, they're authorized. They're authorized at least one level above. So before you do something, you take an authorization from your boss. So this is the A of the ARC. The R is record keeping. So we need to make sure there is adequate records and documentation at the company. Now, as part of record keeping, a good sign for record keeping as far as internal controls is concerned is PPN. We'll talk about that. PPN stands for the documents should be pre-numbered, pre-printed and in a numerical sequence. So let us say I have an invoice book. So I have 1 to 100. So it's pre-printed, pre-numbered and in a numerical sequence. Talk about a bank checkbook again. So you have check number 50, 51, 52, 53, 54. So that's pre-printed, pre-numbered and in a numerical sequence. So PPN. So authorization at least one level above. Recording, adequate records and documentation for everything that's happening. There should be a proper audit trail, proper internal controls. The first C of the ARC, that stands for custody. So there needs to be proper physical security. There needs to be authorized access. You need to have the right kind of security people. You need to guard your company's cash, your company's inventory, your company's fixed assets. You can't have them being misappropriated. Remember when we talked about fraud in audit 2, we talked about stealing. We had theft, embezzlement, a defalcation scheme. So we need to have proper custody of the assets of the company. Very important. So authorization, record keeping, custody. The next C, this is comparison, where comparison is having independent checks, periodic evaluations, monitoring. It's basically compare, check, reconcile, review, investigate. So all that is comparison. You need to have a team doing all that. So guys, we have authorization, recording, custody, comparison. And I said it's not ARC, it's ARCs. The S of ARCs, that's segregation of duties. So we need to have different people do all these jobs. We can't have one man do the entire show. We need to have different people doing authorization, a different team doing record keeping, a different team having custody of the assets, and a different team who's coming in and doing comparisons, periodic evaluations, reviews. So guys, ARCs is authorization, record keeping, custody, comparison, and the S is segregation of these duties. Now it's very important for duties to be segregated. We'll talk about that as we get to a lot of operating cycles. I'll give you a quick example here. Let's talk about the revenue cycle. So let's say we are a company, or rather the management, they are a company and they've received certain orders. What happens? The orders go to the sales team, sales guys generate an internal sales orders. The internal sales order then goes to the credit guys. Now credit guys confirm whether the goods should be sent on credit, whether the customers are credit worthy. If yes, then the internal sales order. So the sales team authorizes that yes, sales should be made. The credit team does another level of authorization that the credit is good. Yes, we can sell goods on credit. After that, the internal sales order goes to the warehouse and shipping guys. So those guys, they have custody of the goods. So what they do, once they receive the internal sales order, they see it signed by the sales team. It's again authorized by the credit team. They push the goods, they send it out to the customer. Now, when the goods go to the customer, we need to raise an invoice. We need to tell the customer that these goods are worth so many dollars and you're going to pay us back. So that invoice is raised by the billing team. Then you have an accounts receivable team which updates the accounts receivable master. So that is how the sales activity happens. Then the comparison, let's say we have an internal audit team there who comes in and checks whether for all the goods that were sent out from the shipping and warehouse team, have they been billed by the billing team? So that could be comparison. So guys, this is ARC, and we had different team doing different job. So let's say authorization was sales team, credit team. Custody was warehouse and shipping. Record keeping, billing team, accounts receivable team. Comparison by internal auditors. So that was when we sold out goods to customers. Then the customer sends in the checks. When the company receives checks from the customer, the checks come into the mailroom of the company. So mailroom have custody of the checks, custody of the cash. Then the mailroom sends the checks to the cashiers. The cashier deposits it to the bank. The cashier also has custody. They send the copy of the remittance advice they've received from the customer to the record keeping team, to the accounts receivable team, who record that yes, we've received payments from this customer for so and so bills. So that is different team doing custody and different team doing record keeping. Then you could have internal auditors who do bank reconciliations to make sure all the checks that have been received from the customers have been actually deposited into bank. So we had selling goods to customers. We had receiving payments from customers. How about bad debts? Let's say there's some customer who's not paying. So you need to have a treasurer to authorize that yes, okay, fine, we sold goods to them. That was not good credit. The customer is not paying off. Let's write it off in our books. Authorize bad debts. Now guys, let's think about it. How about the guy who collected cash from customers? Let's say we received a lot of cash payments or maybe checks which could be endorsed. So the guy who collected cash from customers is the person who's authorized to write off bad debts. Very simple, right? Everybody is getting to where I'm headed. So that guy, he would go to the customers, he would collect the cash, put it in his big pockets, and then come back to the company and say, it's a bad debt. So guys, now you understand how important it is for us to segregate duties. So if this was done by two separate guys, this could not have been done. He could not have stolen the company's cash. So it's very important to have good, sound internal controls in place. Very important component of internal control is control activities, the ARCs: authorization, record keeping, custody, comparison, and segregation of duties. Now, we'll talk about ARCs and the entire internal controls when we're looking at a lot of operating cycles. So the example that I gave you for ARC, that's basically part of the revenue cycle. When we sell out goods to the customers, receive checks, maybe we have to authorize certain bad debts. So that's all revenue cycle, where we're getting revenues. Then we'll also talk about the expenditure cycle. We'll look at the production and conversion cycle. We'll look at payroll cycle. We'll look at investing cycle, financing cycle. Guys, there's a lot to come, and I'm sure we're set for a lot of fun.
We are looking at the components of internal control. And our mnemonic for highlight the 5 interrelated components of internal control is fill in the bubbles there. C-R-I-M-E. So that's the crime. So it's a crime for the management not to have proper internal controls. And the C of crime, the control environment, that's right, the foundation for crime. Now, the original COSO framework was issued way back in 1992. In the year 2013, COSO updated this framework and added highlight 17 internal control principles, because these principles were presumed essential in assessing that the 5 components of internal control, the crime, they are present and functioning properly. I wanted to put a star here for these 17 principles, and let's review these alongside the 5 components of internal controls that we have in the subsequent pages.
So we are here in audit 3 and we're looking at management responsible for the very important internal controls. And we said it's a crime for the management not to have proper internal controls. The C of our crime, that was control environment. And I gave you a chopper for that. The R of the crime, there was risk assessment by the management. I was information and communication by the management. M was monitoring, again by management. Remember, management responsible for internal controls. The E of the crime, that was very important, existing control activities, and we had arcs for that. So we had authorization, recording, custody, comparison, and segregation of duties. Very important arcs for internal controls. Now, even if management has very strong internal controls, it's not necessary that there'll be no mistakes happening. So you might have very strong internal controls, but even then certain material misstatements may crop up on your financials. So you're looking at internal controls for accurate, reliable financial accounting and reporting. Even after having internal controls, there might be cases where the financial reports have certain misstatements. There might be cases where you're not complying with all the laws and regulations, where your business is not running effectively, efficiently. So guys, that is inherent limitations of internal control. Let's look at that. So you have certain inherent limitations. So these are the objectives, then you have components of internal control. Now, as I told you, we're talking about limitations of internal control. So in components of internal control, we use the mnemonic crime. So what's crime? Crime is anything that's not right. It's theft, it's murder, it's drugs, cocaine. Now I know none of us has ever seen cocaine, none of us ever has smoked cocaine, but we know because we know cocaine is a form of crime. Now guys, the mnemonic for limitations of internal control sounds something like cocaine. Now we don't know what cocaine is. We don't even know how to spell it. So we're going to use C-O-C-O-C. I say cocaine because I see that's very related to our mnemonic here, crime. The C, the first C, so you have 3 C's here. The first C is a limitation of internal control. It's a competence issue. Now, you might have strong internal controls in place creating the financials, but the internal controls, that's for a lot of people in your organization. Now, those are human, and human can do errors. So they can have mistakes or misjudgments. There can be competence issues. There could be errors. Now, errors are unintentional. Now, even errors can make your financial statements materially misstated. Remember, material misstatements. Misstatements can be due to error or fraud. So this is competence issues with people not knowing what to do, or people doing something that's not right unintentionally. The O of our limitation, the first O, that's obsolescence. Remember when I talked about risk assessment, the R of our crime, I said if the company has got a new operating environment in place where they are outsourcing, the old internal controls, they will get obsolete. So we said if the company was having rapid growth, they grew from 100 million to 500 million. That's a case of obsolescence of old internal controls. They need to have new internal controls in place. We had a case of company having new product lines, cameras and ACs. The old internal controls, they might get obsolete. So that's a limitation that internal controls have, that they might get obsolete with a lot of changes that happen in the company. And that's why we said it's very important for the management to identify, analyze, and manage risk. The second C of our limitation, that's collusion. This could be very risky. So we said we need to have two separate people for bad debts. So you have one person, the treasurer, authorizing the bad debts, and you have the other guy who's going out and collecting cash from customers. So it's very important for us to segregate duties in the ARC. How about we have segregated duties? The management has rightly segregated duties, but people collude. So you have the guy, the treasurer, authorizing the bad debts, colluding with the guy collecting cash from customers, and they writing off bad debts even after they've received cash. They share cash 50-50. That's collusion. They have colluded, broken down our ARCs. So we had ARCs, but the collusion, the inherent limitation, broke down ARCs. The second O of limitation, that's override by management. Again, guys, let's say you have strong internal controls. You have the crime in place, you have the chopper, you got ARC. Now, the case is we have a CEO who's got a target for getting 10 million of profits this year. He's made 3. He tells his accounting team, he calls his financing team, and he asks them to cook up the books so that the profit is 10 million. He's got incentive, he's got pressure, let's say he's got opportunity because he's overriding internal controls. He is not a man of ethics. That is override by management. So even though the company had proper internal controls in place, management overrid these internal controls. They ran over all those internal controls. So we had an issue, right? Remember the Satyam case here back here in India? So you had Satyam as a company which had strong internal controls. But all those internal controls were simply run over by the management who overrid the internal controls, cooked up their books. So guys, this could be a big problem. It's a big inherent limitation of internal control. You might have internal controls in place, but if management overrides, there's no point having all these internal controls. The last C of our limitation, this is cost benefit constraints. So you have a lot of requirements to have internal controls in place. Now, these might end up being very expensive. Let's say we have segregation of duties, different people doing different jobs. That's perfectly okay if it's a big company. They've got thousands of people, perfectly fine. How about a small company, 20 people? Not always possible to have segregation of duties. There might be cases where one person is doing more than one job because the company cannot afford 2 people for those 2 jobs. That's a cost benefit constraint. That's a limitation of internal control. They want to have the right kind of internal controls, but it's simply too expensive.
We are looking at a C of crime, that's highlight control environment. And we are talking about, right, tone at the top. So it's basically the board of directors and senior management, the top guys who establish, highlight the tone of control consciousness regarding the importance of internal controls. So basically, once again, control environment is highlight the foundation for all other internal control components. Control environment factors, they include competent individuals. The organization needs to have a process to attract, develop, and retain these competent guys. Right there, by HR. Next factor is organizational structure. So there needs to be an appropriate structure and reporting lines. Next, we got performance. So the organization needs to drive accountability for performance. Next, we're talking about those charged with governance. Right there, parameters of. So there needs to be parameters which enable those charged with governance, specifically the board of directors and the audit committee, to carry out their governance oversight responsibilities. Next, we got ethical values. The last one is responsibility assignment, where there's a need to define, assign, and limit authority and responsibility. Now, given that control environment that's so important, I'm going to give you a couple of mnemonics, 2 mnemonics, to ensure that you never forget the control environment factors. So guys, as we know, control environment that's established by board of directors, the senior management, the top guys, to ensure that there is a tone of control consciousness throughout the organization. So our mnemonic here is going to be chopper or copter, which fly on the top, making sure everyone's serious about internal controls. So let's fill in the bubbles there. C, O, P, T, E, and R. So these are the very important control environment factors. And as I promised you, I'm going to give you another mnemonic here, which is chopper. Highlight the C of competent individuals, the H of HR. Highlight O for organizational structure, P for performance. The next P, highlight parameters of those charged with governance. Highlight the E of ethical values and the R for responsibility assignment. So guys, management needs to install those copters and choppers on the top to ensure that there is a proper tone of control consciousness, to ensure that there is a proper control environment for internal controls. And given that I've given you 2 mnemonics now, I'm sure you never are going to forget these control environment factors. Before we move into the next component, let's look at a few examples of circumstances which could raise concerns regarding the control environment. So you have excessive pressure on management to meet financial targets. You have domination of management by a single person, or a lack of a culture of honesty and ethical behavior. These are all problems to the control environment. These raise concerns. So when we talk about excessive pressure on management to meet their targets, we could say this one's right, pressure. Domination of management by a single person, that sounds like an opportunity. And if there is a missing culture of honesty and ethical behavior, that could lead to right rationalization. Highlight the R of a crime, risk assessment. And right there, by management. So guys, management is responsible for putting in place the internal controls. So when we're talking about risk assessment as a component of internal control, we are talking about risk assessment by the management. So risk assessment is a dynamic and iterative process for highlight identification, analysis, and management of risks. Now, when we talk about risks, they highlight include external as well as internal factors. The I of a crime, that's highlight information and communication. Right there, includes the accounting system. Now, the organization must be able to obtain or generate and use underlying relevant quality information to support the functioning of internal controls. The organization should underline communicate internally information including the objectives and responsibilities for internal control, which is necessary to support the functioning of internal controls. The organization should underline communicate externally regarding matters affecting the functioning of internal controls. Next, we've got the M of crime, highlight monitoring. And right there, by management. So management needs to ascertain whether each of the 5 components of highlight internal control is present and functioning. There's a need for underline ongoing and or underline separate evaluations. The organization needs to be able to underline evaluate and communicate internal control deficiencies in a timely manner to responsible parties for taking corrective action, including the senior management and board of directors as appropriate. We have our last component of internal control, the E of crime, highlight existent control activities. Now, examples of specific control activities include those relating to highlight performance reviews, highlight information processing, where we look at highlight general IT controls. So these are policies and procedures that underline relate to many applications and support the effective functioning of application controls. For example, underline access controls, underline hardware or software controls, underline controls over data centers and networks. And then you've got highlight application controls, which apply to the processing of underline individual applications. For example, controls to underline check arithmetical accuracy, controls to maintain and review underline accounts and trial balances, underline automated controls such as edit checks of input data and numerical sequence checks. It could also be underline manual follow-up of exception reports. So basically, general IT controls, they relate to many applications. Application controls relate to specific applications. I mean, these could be automated or manual. Then you have highlight physical controls. These are controls that encompass underline physical security of assets and records, underline authorization for access to computer programs and data files, underline periodic counting and comparison with amounts shown on control records. For example, for cash, for securities, for inventory. And the last one, very important, highlight segregation of duties and put a star there. So management needs to have different people or different teams doing highlight authorization, recording, custody and comparison. And we know our mnemonic here is ARCS. So fill in the bubbles there. A-R-C-C. And the S of ARCS, that's segregation of duties. So I want you to write the mnemonic again, right there. A-R-C-C and separate them out with lines. So guys, the point is there needs to be authorization, recording, custody and comparison, and these duties all need to be segregated.
Let's quickly look at some of the regulations that we have on internal controls. So you remember back in Audit 1, we looked at SOX, the Sarbanes-Oxley Act of 2002, which applies to issuers, public companies. Rule 302 of SOX said that management is responsible for internal controls. I'm sure you remember that. You had another rule, Rule 404, which said that the auditor not only gives an opinion on the financial statements, he also gives an opinion on internal controls over financial reporting. So it becomes an integrated audit, an audit of internal controls integrated with an audit of financial statements. So guys, internal controls over financial reporting. So you have internal controls taking care of a lot of things: financial reporting, compliance, business operations. As auditors under SOX, this is the key consideration, the FAR objective, financial accounting and reporting objective. That's the major focus. So Generally, we said that the auditor only assesses internal control. If it's an issuer, public company, the auditor also needs to express an opinion over internal controls. And here we're looking at internal controls over financial reporting.
We're looking at the limitations of internal controls. Basically, even an effective system of internal control can experience a failure. Therefore, we say internal controls, they provide reasonable but not absolute assurance. Now, the limitations of internal control may result from highlight competence issues, which could be underlying mistakes or underlying misjudgments. Highlight obsolescence of existing internal controls due to externalities. Highlight collusion, where management, other personnel and third parties collude to circumvent the internal controls. Highlight override by management. So basically you've good internal controls in place, but the top management, they override the internal controls. The last one here is highlight cost constraints. Basically, the cost of internal controls may exceed the benefits derived. And our mnemonic to remember these limitations of internal control is fill in the bubbles there. COCOC. We're looking at a couple of key regulations for internal controls. Highlight the Foreign Corrupt Practices Act, which was passed way back in 1977, which makes it underline unlawful for issuers to pay bribes to foreign officials. And the next one, we have the very important highlight the Sarbanes-Oxley Act, passed in 2002. We spent a lot of time talking about SOX in Audit 1, but let's look at the key provisions for internal controls. Highlight section 302, which makes officers or management responsible for internal controls. Right there, management equals internal control. And then highlight section 404, where you have auditors who are required to attest to management's assessment of effectiveness of ICFR or internal controls over financial reporting. So guys, we know that pursuant to SOX, issuers need to have an integrated audit. That's an audit of financial statements integrated with an audit of internal controls over financial reporting. So right there, auditor, express opinion on financial statements plus ICFR, and within brackets, write integrated audit.